George of the jungle, strong as he can be.
What do you do when there's more money on the closing table than you can properly allocate? That's what we're going to be discussing today in thecreditjungle.com. This is George Anderson. And you know what? In today's market, this is really kind of an irrelevant video here, but back in the old days and maybe, sometime in the future, whoever knows when, you might actually see contracts coming in where the seller is paying some of the buyer's closing costs. That used to happen quite often, but not in this market. We've got buyers paying the seller's closing costs, their title insurance and their settlement fees and anything else that you can think of. So anyway, but in a normal world, there are limits to how much it's based on a percentage of the sales price. And so it can be as low as 2% on a conventional non-owner purchase, or it can be as high as 6% FHA, or with VA, there's actually some provisions where the seller can pay bad debts that the veteran may have coming into the home, judgments, tax liens, something of that nature, provided that there's enough room in the appraisal to be able to raise the sales price and to add that in. But we're going to be talking about a little bit more common scenario here, where let's just say that we've got a contract where the seller agrees to pay $7,500, but we get to the closing table and we find out that the closing costs, when they all add up, are really only $6,800. Well, how do we get rid of that extra $700? Well, if it's only $700, a very easy way to do that is just right at the closing, we just take the seller's excess money there and we can buy a home warranty. And you can adjust that premium, you can dial it in based on the type of coverage, the deductible, and the number of months that you want that, or years. To get it as probably as cheap as $300, or you could probably get it as expensive as $1,500. Trust me, the home warranty companies are going to be very flexible to be able to dial that into a premium that would use the amount that you have left over. Some other things that you can do is the borrower could go and get additional coverage on their homeowner's insurance at the last minute. We can just change the quote. Now it's going to affect the debt ratios and everything else because it has to be put into the premium, but they could get a lower deductible, they could get more coverage, get a Cadillac policy, and they could use that up that way, and that could be done at the closing table. The other possibilities that you can do here, and this you really wouldn't do this unless you were looking at, if you've got more money to play with than is available to be taken up here with a home warranty or with some homeowner's insurance. These other options here, you can do these on one condition, and you need to know this before you get to the closing table, because this is going to require that you have to redisclose, because you're going to be changing some of the terms of the loan. So what you can do is, like, let's just say that instead of $700, maybe we had $2,700 extra. For whatever that may be. Now there can be, you can use that to, if there was mortgage insurance on the loan, some of the mortgage insurance companies have a very flexible fee schedule, so that if your mortgage insurance was going to be just solely $200 per month, for example, that you can say, well, we've got an extra $1,700 here. Why don't we give the mortgage insurance company $1,700 or $2,700 up front? And then if we do that, would they lower the monthly mortgage insurance because they're getting some of it in advance, and then would they take less monthly? Well, the answer is yes, they will do that. That's a split premium or a single premium. You can structure it. There's a lot of different ways to be able to do that, because just like the home warranty companies, if they're figuring out how to collect money, they're going to be very flexible in how they collect that money. So you can do that, and that would reduce the amount, the actual house payment, because you're taking some of these excess closing costs and allocating it towards paying some of the mortgage insurance premium up front. So that's fine. And another thing you can do is, if you know it in advance, you can say, well, wait a minute, we've got an extra $2,000 here. If we had the borrower locked at, say, like a 3% rate, and we'd say, well, wait a minute, with that extra money, we can buy discounts and we could buy down the interest rate and get that rate down to maybe 2 3/4 or just whatever it is on that particular circumstance. But anyway, those are both very viable options to be able to use this excess closing costs, but this is going to require some redisclosure, which is going to trigger at least an additional 1 day, depending on how you're doing this. There is a fifth one up here, And this one is something that you don't use very often, but it can come into play once in a while, especially if there were some repairs or some things that there were some expectations that maybe the seller was going to leave the fridge or some appliances, but they're all kind of buggered up or whatever. The seller can't give the buyer money just like cash at the table. They can't do that. It has to be stuff that's going towards the transaction. But sellers oftentimes are asked to be able to make repairs and fix things and do stuff prior to leaving the home. And the expectation is that if a contractor came into the house and did some work, that they're going to be paid, okay, by the time that work's done. Well, in the case that it's not, just suppose that there was $2,700 worth of a contractor bill for, you name it, floor coverings, window repairs, appliances or whatever. What you could do is you could reduce the amount of closing costs that are going towards the loan on there, and that would not trigger anything as far as redisclosure